Guys, I hope everyone is fine. Today we're going to see together how a DCF model works. So the purpose of a DCF valuation methodology is to obtain the value of a company today based on the cash flows that such company is expected to generate in the future using a proper discount rate. As always, the first thing that I suggest to do is to have a first block in which you would list the assumptions you would need for your model. And here you would need to have an assumption regarding the perpetual growth rate. This is a notion that we will define together in a few moments. You would need to have the effective tax rate of the company, and you would also need to have the discount rate, which is the weighted average cost of capital. Once you have done that, you can start building your DCF model. And here there are two topics with which we would need to start. The first one is the period or the duration of the business plan. Usually and ideally you should use a business plan over 10 years, but you can also use a duration of 5 or 7 years or whatever number of years you have depending on the data which is available for you. This is regarding the duration, and regarding the source from which you can obtain the business plan. You can either obtain it from the management of the company, if of course the management of the company is your clients and they are willing to share such information with you. If you are working on a publicly listed company, you can use broker reports. In broker reports, you would usually find financials over the next 3 to 5 years, sometimes a little bit less depending on the industry. Here, what you can do is use whatever financials are available in the broker report, and you can use your own projections in order to extrapolate those financials over the next couple of years in order to have a business plan which is a little bit longer than the period which is provided by the broker reports. Another case in which you may find yourself is to work on the valuation of a private company. As you know, financials for private companies are usually very scarce, and sometimes you would need to build your own business plan using whatever financials are available to you, and also using sensible drivers in order to build your model. For instance, if you have only the revenues in year one, you can use the growth rate over the last couple of years and assume that the company will continue to grow at the same historical growth rate over the next 5 or 10 years, and use it as a driver in order to build the revenues over the business plan period. The same goes for the EBITDA margin. For instance, if you have the EBITDA margin in year one, you can assume that the EBITDA margin is going to remain flat over the next couple of years, or you can assume a slight improvement in the EBITDA margin, and you can build in this way. You can have the EBITDA over the next couple of years, so on and so forth. So those are the first two items that I wanted to discuss with you. The first is the duration of the business plan, ideally 10 years. If you don't have 10 years, you can use whatever lifespan you have. But you should avoid to have a business plan which has a lifespan which is lower than 5 years in order to protect the accuracy of the model. So the second topic is the sources from which you can have the business plan of the company. You can either obtain it from your clients, you can either work on the basis of broker reports if the company is publicly listed, or you can build your own business plan using whatever financials you have, and also using sensible drivers in order to drive the data forward. In terms of the financials that you would need to have in your DCF model, we usually have the sales and also the other financials which are required in order to build the free cash flow to the firm. So you have the EBITDA, D&A, EBIT, the tax on EBIT, the change in working capital, and the capex. Once you have your business plan, you can calculate the free cash flows to the firm using the formula. It's EBITDA minus tax on operating profit plus or minus the change in working capital minus the capex plus or minus any foreseeable exceptional items. So this is the first step, is the calculation of the free cash flows over the business plan period. Then you would need to discount those free cash flows in order to express them in a value as of today. This is the time value of money. As you know, a dollar today is not worth the same as a dollar tomorrow. You would, of course, prefer to have a dollar up to obtain a dollar today rather than obtain it tomorrow. So this is the time value of money. We would need to discount the future free cash flows in order to express them in dollars in today's value. So what you could do here is to add a line in which you would have the discount period. This just reflects the year in which the free cash flow to the firm is expected to be generated. For instance, you would put number 1 in year 1, number 2 in for year 2, etc. until you put number 10 for year 10. You would need, we will use this discount period in order to calculate the discount factor. The discount factor is the factor by which we are going to multiply the free cash flows to the firm that will be generated in the future in order to express them in dollars as of today. So it's the discount factor that we are going to use to discount the free cash flows. How do we calculate the discount factor? The formula is 1 divided by 1 plus the discount rate to the first power in the first year. In the second year is gonna be 1 divided by 1 plus the discount rate squared. In the third year it's gonna be 1 divided by 1 plus the discount rate cubed. In the fourth year it's gonna be 1 divided by 1 plus the discount rate to the fourth power, etc. And you continue doing this until the last year of your business plan. And here, as you see, the discount factor is getting lower and lower while you are moving downwards towards the last year in the business plan, which means that the cash flows that are generated in the in the first years of the business plan are going to be depreciated less than the cash flows that will be generated over the last years of the business plan, which are going to be depreciated more than the cash flows generated over the first years of the business plan. So this is the time value of money. The further in time a cash flow is generated, the further it is going to be depreciated. And this is reflected in the discount factors that you see here. Once you have done that, you can calculate the discounted cash flows by multiplying the free cash flows to the firm by the discount factor. You just multiply each time the cash flow to the firm by the discount factor and you will obtain the discounted cash flows. So this is the first layer of your DCF model. This is the first layer of the EV. As you can see here, we calculate the present value of the 10-year cash flow. So you sum the discounted cash flows and you will have the first layer of your EV. The second thing you would need to know is that the activity of the company will not stop at the end of the business plan period. After the last year of your business plan, the company will continue its activity and will continue to generate free cash flows to the firm. As such, we use a terminal value in order to capture the value of all the free cash flows that are going to be generated beyond the last year of the business plan. You could, in theory, not use a terminal value and expand your business plan until the life span of the company, but in practice this is very hard to model. You would need to have 100 years at least, or depending on the lifespan that you predict for your company. So what we do is we use a terminal value in order to capture the value of all the cash flows that are going to be generated after the last year of the business plan. So in order to calculate the terminal value, you would need to estimate a normative cash flow. A normative cash flow is a recurring cash flow is an estimation of a recurring cash flow that would happen annually or periodically after the last year of your business plan. So this is what I did here in the normative column. Let's see how it works line by line. The normative sales, for instance, you could use the last year of your business plan sales and make them grow at the perpetual growth rate. So the perpetual growth rate is the growth rate at which the normative cash flow is gonna grow at perpetuity. You can either use here the growth rate of the economy in which the company operates. So in practice is the GDP growth. You could use the long-term inflation forecast, or if you have any specific indication for the growth over the long term of the company, of the industry in which the company operates, you can use it as well. Just keep in mind that you usually use the GDP growth rate as a cap, since a company cannot grow at perpetuity at a rate which is higher than the growth rate of the economy. Otherwise, it would end up being bigger than the economy in which it operates. So this is for the normative sales. For the normative EBITDA, we can just use the EBITDA margin of the last year of your business plan. You could also use the average margin over the last 5 years or the average margin over the last 10 years. But if you don't have any particular information, you can just assume that the last year of the business plan reflects a normative level that's gonna continue at perpetuity. For the D&A, you can use the same driver that you used over the business plan period. Here, I built the D&A as a percentage of revenues. So I use the same percentage of revenues that I used over the business plan period for the normative cash flow. Here, for instance, I assume that D&A over the business plan period are equal to 2% of revenues, and I just use 2% of revenues in order to derive the normative D&A. As for the EBIT, it's just implied as the difference between EBITDA and D&A. Regarding the tax, it's just the effective tax rate multiplied by EBIT, as you can see here. For the change in working capital, it works exactly in the same way that we have built the D&A. I use the particular driver to estimate the change in working capital over the business plan. I built them as a percentage of change in revenues, and you can do the same in the normative free cash flow. Sometimes in some industries it is hard to forecast the change in working capital, and I've seen some broker reports use zero as a change in working capital for the normative cash flow. So you can do both. I would advise that you keep the same driver that you use over the business plan period. But sometimes if you don't feel comfortable that your driver is sensible at perpetuity, you can just put zero here. Regarding the capital expenditures, you should keep in mind that in the normative cash flow, they should be equal to D&A, at least. This is because a company cannot continue to grow if it does not invest at least the amount of the depreciation. So if the company depreciates a certain number at perpetuity annually, it should at least invest the same amount in order to preserve its asset base and continue to grow. So this is usually how we build a normative free cash flow. The formula is of course the same. And once you have your normative free cash flow, you will be able to calculate the terminal value in year 10. So this is the Gordon-Shapiro formula that I used in this model. The value or the terminal value in year 10 is equal to the normative free cash flow divided by the discount rate minus the PGR being the perpetual growth rate. So you can obtain it either using the Gordon-Shapiro formula, just like what I just did, or there is a second methodology here. You can use a multiple. For instance, you can use an EBITDA multiple in order to have the terminal value in year 10. So once you have calculated the terminal value in year 10, you would need to discount it as of today. So it's the same. This is you will use the same discount factor that you use to discount the free cash flow of year 10 in order to bring the terminal value in year 10 from year 10 to today. So the discounted terminal value is here. So now that we have the discounted terminal value and the present value, which represent the discounted terminal value, the terminal value, as I previously said, represents the value of all the free cash flows that are expected to be generated after the last year of your business plan. And also at the beginning, we calculated the present value of the free cash flows that are generated over the business plan period. In my example, from year 1 to year 10, you would have the two layers that constitute the enterprise value. So the enterprise value being the sum of the present value of the 10-year cash flows and the discounted terminal value. So you see here in this example, the terminal value represents roughly 60% of the value. So it depends on the duration of your business plan and your assumptions, etc. But in this example, the terminal value represents 60% roughly of the EV. Once you have the EV, you can subtract or add the bridge items in order to obtain the equity value. In this example, I assume that the company I'm trying to value has a net financial debt that I subtract. It also has minority interest that I need to subtract. It also has pension liabilities that I need to subtract, so on and so forth, and I obtain the equity value. So that's it, guys, for the DCF model. This is usually how it works. And one last thing that we usually do is that we run a sensitivity analysis. As you will see, the valuation is usually highly sensitive to the discount rate and to the PGR. If you see, for instance, I have an EV of 181. If I change the discount rate, I can put 8% here. You see, it moved to 252. So it's very sensitive. And what you usually do in order to have a sense of the sensitivity of the valuation to those technical parameters, which are the WACC and the PGR, we just put a small table here, which is called sensitivity analysis. Usually in the presentations, you would collate this table, and below this table, you would have this, below the DCF table, you would have this small sensitivity analysis that would enable the reader to understand how the valuation would move depending on the WACC which is used and the PGR assumption that is used. So in order to build this sensitivity analysis, the first thing you would do, you link this cell here at the corner of your table to the EV. I just put it in blank in order to hide it, but I could put it in dark here so you can see it. Once you have done that, you just select the table, you go to data, you go to what if analysis, you go to data table. Regarding the rows, I have put the WACC in the rows. So you click here and you select the WACC. And for the column, as you see in the column, I have put the PGR. Click here, you select the PGR in your assumptions, and then you click OK. And your table is created. As you see, I have used 10% WACC, 2% PGR. I look out for those assumptions in my table, 10% WACC, 2% PGR, and I find the exact number, which is the EV of 181, which means that using 10% WACC and 2% PGR leads to an EV of 181. If I used a 12% WACC and 3% PGR, for instance, the EV would have been 146. So you can have here, reading in this table, the EV depending on the valuation parameters that you use. So this is something which is very widely presented in valuation presentations. So that's it, guys. I hope that this video would provide you with a good overview of the functioning of a DCF model. If you have any questions, just drop me a message. Bye-bye.